Cloudflare stock is down over 15% after reporting Q3 earnings yesterday. That's to go on top of a 78% drop over the last year. We'll get into the Q3 numbers on today's show. We'll take a look at the revenues, the profits, everything that you need to know, and some of the reasons why this stock is trending down in the regular trade. And then we'll come over here and look at this from a technical perspective. It has bounced today. It has been as low as about $39 per share. It's currently sitting more closer to $42 per share. That level that it's bounced off of, at least temporarily, is a good sign for anybody that is bullish Cloudflare. What is going on, investors? Hopefully you guys are doing well out there. Excuse the hoodie. It's a little cold out here in California, but we're going to dive right into Cloudflare, ticker symbol NET. We've got a $13.7 billion valuation on this one. We'll certainly keep that in mind as we roll through these results. Q3 earnings came in at $253.86 million. That was just 47.3% growth. Anytime you see that type of growth rate, you better believe that the valuation is probably going to be a little elevated. And we talked about how we've got a $14 billion market cap on this one. They say for the full year that the company is going to do just a shade under, and a shade's like $975 million. They're going to do about that much in revenue for the full year. And obviously a company like this is not profitable. And so you are paying a solid 14 times sales, maybe even a little more than that, on a company like this. And look, it's okay to pay that much multiple on sales if you have a gigantic growth rate, not only in this quarter, but subsequent quarters as well. And then when we look at analyst estimates over at Cloudflare, and it certainly lines up, okay? For the upcoming fourth quarter, analysts were expecting right at about $274 million worth of revenue. The company essentially reaffirmed that on the most recent earnings report, saying that they'll come between 273.5 up to close to $274.5 million. So they essentially just kind of came in on analyst estimates on this one. Looks like a very predictable business from a revenue perspective, since analyst estimates are very close to each other, at least in the shorter term. When you start to stretch out, though, analysts are still expecting growth at this company, but it's going to come south of 40%. And on top of that, you start to see the deviation between the high end and the low end of estimates start to spread out quite a bit. And so there's that risk that Cloudflare actually comes towards the low end of revenue estimates instead of the high end revenue estimates, and therefore likely coming underneath the expectation, which is the average between the two. So if you are bullish Cloudflare, you need them to come towards at least the high end of these estimates, or at least the high end of these consensus estimates. If you are bearish, or you think that maybe you'll be able to buy this one at a lower price, or you want to short this stock, you need for it to kind of come in towards the low end estimates when we look out into 2023. The revenue estimates, I would assume, for the next 2 quarters are relatively baked into this stock. Now, what I also noticed in the most recent quarter, the Q3, is that our gross margins ticked down a little bit. Now, when you have 78.2% margins last year on a GAAP basis, and they go down to 75.6, it's kind of a first world gross margin problem, but you are seeing a little bit of compression there. And obviously, if you keep ticking off 2-3% on your gross margin rate year after year, well, all of a sudden you go from 70s down to 60s, and maybe even a little bit lower than that. It's also potentially showing you that the pricing power in this difficult environment, not necessarily there like it was last year for Cloudflare. Now, what's still there with Cloudflare is explosive revenue growth. You went from $172 million worth of revenue last year on a quarterly basis, all the way up to close to $254 million. The other thing, look, gross margins, yes, they went down, but this is a wildly profitable company from a gross margin perspective. And this company actually checks 2 of the boxes that Wall Street actually fell in love with during the 2020-2021 era of the stock market. They loved high gross margins, and they loved high revenue growth rate. Now that we're in a higher interest rate environment, these are the exact stocks that Wall Street actually has thrown out. And the thing we have to start judging with investors is, when is Wall Street going to like these stocks again? Because they will start liking these stocks again, because there is a lot to like. So off of $254 million worth of revenue, you had nearly $192 million worth of gross profit. Now, like a lot of these companies, is all of your gross profit gets chewed up in your operating expenses. Notice your sales and marketing. Okay, yes, yes, we had explosive growth year over year on that revenue side, but your sales and marketing actually exploded as well, from about 86 million all the way up to 116 million dollars. So almost all of your gross profit, all but about 75 million of it, actually gets chewed up just in sales and marketing. But guess what? You got research and development as well. That ticked up $30 million from 46 million all the way up to $76 million. And then you've got the all important general and administrative line where a lot of money gets burned at these types of companies. You went from about 29 million all the way up to 45 million. So your total operating expenses year over year went from 161 all the way up to $237 million. So you take your $192 million worth of gross profit and you minus off about $238 million of operating expenses, and you get a loss from operations here sitting right about $46 million. That's $20 million higher than it was last year when you were closer to $26.5 million worth of losses. Now, if you want to, you can flow all the way down to net income. Last year, this company had a loss on an extinguish of debt. My guess is maybe they paid some convertible notes or something like that, and they had to recognize a $72 million loss on that. So last year, they actually lost 34 cents per diluted share. This year, they only lost 13 cents. But this is why I think as an investor, just make your life so much easier. Don't worry about EPS. Don't worry about net income or net loss in this perspective, and focus just on your losses from operations. Just focus on the business operating itself. And you see over the last year, yes, despite the explosive revenue growth, the operating expenses accelerated even more so, and it led to more operating losses over this company. We can get further insight when we come down to cash flows, because obviously there's a lot of stock-based compensation, which they strip out for you here in this company. So from a cash perspective, it's not nearly as bad as what it looks like on the profit and loss statement. But look, in this environment, that is what investors are looking at. They're looking more at operating results versus kind of a high growth rate, high gross margin business like they were during 2020 and 2021. Now, let's come down here to the balance sheet. The company still has plenty of cash. They've got a relatively fair amount of convertible notes here, which you'd assume will have to convert at some point for this company. They have enough cash to cover them, but also that could lead to convertible notes into the form of equity. But all things being considered, relatively flat on your total assets year over year and somewhat flat on that liability side. Now, here's where it gets a little bit better for Cloudflare. Certainly, if you're bullish this stock, you have a 9-month ended cash flow statement here. You pull down the net income. So the way you get your net income is you come up here to profit and loss, and you come over to the 9 months ended, and you come down and pull your net loss down, and you arrive at a net income number. So you come over here to cash flows, you pull that 147 down, you compare it to last year where you were actually worse at $182 million, and you get to start adding things back in that are not cash. So things like depreciation are a non-cash charge. That was $72 million over the last year. They have some non-cash operating lease cards. You have amortization, which is non-cash. Then you have the all-important stock-based compensation line, which is controversial a little bit. I personally would not add this back in dollar for dollar. These employees have to work for something. They're not going to show up and work for free. And certainly if your equity price on the security you're rewarding these employees with continues to make this move down, well, you're going to have to either issue more of this equity, or you're going to have to start issuing a more mix of a cash. You see over the last year, it was $61 million last year for 9 months. This year, all the way up to $142 million. That means that their stock-based compensation almost exceeded their net loss. So that's clearly not a good thing. You add back in and subtract some things over the last 9 months, and you come all the way down to net cash provided by your operating activities, and it actually paints a pretty good story to the tune of $45 million worth of positive cash flow over the last 9 months. Last year, you're sitting close to $24 million. So they've done a nice job there, and this gives you insight into actually operating the business. If you factor in that the employees are essentially working for shares instead of cash, the company actually generates a small profit from a cash flow perspective. Now, they still burnt through, though, on property, plant, and equipment, $150 $103 million over the last 9 months. What are they spending this money on? I would guess server equipment. Last year, it was $65 million. So you had a big acceleration them. Obviously, this company has to build up infrastructure to handle this kind of 30% growth rate into the future. So there's another risk with this type of company is they invested $103 million worth of property, plant, and equipment over the last 9 months, really to service their business over the next likely 12 months, maybe even a little bit longer than that. And so if this growth rate slows down a little bit, you'll have a situation like you're kind of seeing in big tech where they really accelerated hiring and investment, and now they're starting to walk that back and pull that back. Not necessarily saying that's going to happen with Cloudflare, but obviously a risk with this stock. They burned through over $215 million on those investing activities. They burned through another 1.6 on the financing activities, and you see net decrease in cash over the last 9 months actually was $171 million. So they actually did burn through about $171 million over the last 9 months. And you come up here to kind of the straight cash line of the balance sheet, you've got a shade over $1.5 billion. So they certainly have plenty of cash to survive many, many months, or a better way to say it is probably many, many years. However, again, if that growth rate starts to slow, if that cash flows gets turned on its head, where the employees are not accepting stock-based compensation, well, that certainly could impact the company's finances in the future. Now, obviously, Wall Street kicking this one out, not only the last year, but certainly today as well, although it did bounce off a very predictable area, which we have now in kind of a bolder red line, right around $43, $42 per share. You could call it anywhere in kind of the low 40 range. This stock bounced off that level back in June. It acted as resistance back in June, July, August of 2020. And then once it got solidly over that $42 range, well, this one went on a run. It went all the way up to $220 per share. And obviously has given all of that back. Me personally, I look at a stock chart like this and I've seen it about 100 times over the last 6 months, and none of them, I mean, maybe there's a stock out there, you can leave me a comment down below, but I have not seen a stock make this type of recovery where it finds footing at what would be perceived as a pretty decent level of support and then all of a sudden bounces back solidly. And there's certainly a couple of areas here with Cloudflare where you have this level up here at about $87 per share acted as resistance here, support here, and then there's a intermediate area below that at about $65 per share. These are going to be resistance on the way back up. Wouldn't surprise me if this stock consolidates kind of in that high 30s up to about $60 per share, but I probably would want more data before I really went heavy into this one. If this is like a 1%, 2% type portfolio thing for you, then by all means, the growth rate, the gross margins on these types of companies, and certainly the runway is here for success. But given that you have so many quality stocks and quality ETFs and really the markets themselves that are down so big this year, I don't know if you really need to take an outside risk in a stock like this. I would actually wait for the data to get more clear and the data to get more evident that we are in a turnaround. And not only that, you need Wall Street to really start buying into these names. You're still paying 13, 14 times sales on a company like this. And absent of a buyback, a dividend, and any kind of profits, that is certainly a steep price to pay in any market, but particularly the one we're in today. Hopefully you guys enjoyed today's video. I'll be back again later today for the FANG Stock Recap Show. Good luck with your investments.